hopefully, as you're listening to this, you're going to be into multifamily for the long term. What's occurred in the last couple of years that has led us to where we are in this part of the market cycle? What do you hear now? As of this recording, crypto is hot. It is crazy right now. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to lesson, we are going to be discussing Freddie Mac and the delinquency that they're discovering in the multifamily market. And a few things that you can do, but we really need to learn the history of why this is happening, what's going on, and is it similar to 2008? And ultimately what you can do to not avoid getting caught in this mess that's occurring in multifamily right now. And it's really interesting when you look at multifamily. A couple of years ago, it was hot as a pistol, as a lot of Southerners like to say. I like that term, by the way, hot as a pistol. And it's interesting now, not many people talk about it. You don't really hear it. What do you hear now? As of this recording, crypto is hot. It is crazy right now. If you bought Bitcoin, you're probably a happy camper. Multifamily, let's put it to the side. That's what we like as multifamily investors for the long term. Because when you put things to the side and when money flows to one asset prices go up. And that's what happened in 2021 and 2022. You couldn't find deals. But what's occurred in the last couple of years that has led us to where we are in this part of the market cycle? Well, number one, floating rate debt. Jake and I like to say buy right, manage right, finance right. That's what the Wheelbarrow Profits Academy is all about. That's what the framework is all about. If you want to learn more on how to invest in multifamily and how to use the framework and how to make these mistakes that I'm about to go over right now, just go to wheelbarrowprofits.com, schedule a call with one of the advisors. See how working with the team will help you to implement the three-step framework. And if you want a free book, just email me, Gino at jakeandgino.com, and I'll send you a free PDF copy of Wheelbarrow Profits and the three-step framework. But back in 21, how many of you out there were like, there's no deals out here. I can't find a deal. Well, that was Jake and myself. We couldn't find deals, or at least we couldn't find deals that made sense with a certain type of debt. We didn't want to get into this floating rate. Now, once again, bridge debt gets a bad name. It's a bad rap. It's a great tool when you understand when to use it and how to use it. If you're a newer investor in a market that's very frothy, where you have supply chain issues, where you have labor shortages, where things take a lot longer to get done, 3 years may not be enough time for you to turn a 150 unit asset. And you're getting bridge debt when rates are historically low. They ain't going lower. There's only one way to go. So there's an inordinate amount of risk. I think Warren Buffett said it best. I'm not sure who said this, but I think actually Donald Trump. This was in my video from last week. If you take care of the downside, the upside will take care of itself. Well, you're not really taking care of the downside if you're getting floating rate debt at a low rate when rates can't go any lower and they're poised to go higher, and you think you're going to say to yourself, I'm going to buy a rate cap. Well, now rate caps are starting to expire. Now that's the problem. That's the first step. That's the first domino that's starting to fall. And why am I repeating this? Because hopefully, as you're listening to this, you're going to be into multifamily for the long term. This isn't the next 2 or 3 years. You're going to see this cycle again. They're going to lower rates sooner or later to spur the economy. Rates are going to drop. Things are going to get frothy again, and people are going to go out and use bridge debt. Just understand how to use it. Now, the next one is operating costs. Inflation. Operating expenses really went up dramatically in 21 and 22. Some hurricanes happening down in Florida, a lot of weather events in Texas. Insurance doubled in a lot of markets. We were paying $300 per door in certain markets in Tennessee, and now it's $600, but rents haven't gone up that much. Property taxes exploded. Labor went up. I mean, last year, if I'm not mistaken, in 2024, inflation under Biden was 9%. That is tremendous. That's a big number. Now, rents didn't go up 9%. So you're seeing operations going up. Now, the third one is what Freddie Mac is saying, tenant affordability. Well, now all of a sudden, the economy's slowing down. Rents have gone up from 21 to 23. When Jake and I started in Knoxville back in 2013 on our very first deal, rents were $350 for a one bedroom. We still own that property now. It's 2025. Rents have gone from $350, they've gone all the way up to $1,100 for that one bedroom. Now, has people's income in that market tripled? I don't think so. But you see what's happened? And now that's, even if you take it a microcosm and you go to what happened between 21 and 22 and 23 and 24, rents jumped up 30 to 40%, maybe more in some markets. So all of a sudden, residents that are living there are getting squeezed out because someone coming from California can pay an extra $500 a month to live in Nashville or to live in Chattanooga or to live in Knoxville. And the residents that are there can't afford it. That's a problem. Tenant affordability is I think at one of the forefronts. But the irony is still in the US, on average, it costs around $800 to $1,000 per month less to rent than it is to buy a home. That's why homes are sitting on the market now. They're not going to sell. They're on there for much longer. And the last one, like we said, over leverage. We did a deal last year in 2024. Beautiful deal. 2019 asset, 62 units. We got 80% loan to cost. Great deal. This year, very similar asset, right down the street from that one. Bought a 68 unit. The credit union, what they said was, yep, we can't do loan to cost. We're going to do loan to value. 72% loan to value. And we were puzzled. And the underwriter was puzzled. And what's going on is all of a sudden, banks are starting to pull back. Think of debt as the circulatory engine of the economy. As debt goes, so goes the economy. When debt's cheaper, things are fueling, things are kicking ass. But as debt starts to pull back, things get to be more costly. That's why lowering rates is not only going to help the market of real estate, it's going to help people who have car loans, people who have credit cards, people who have other types of debt, lines of credit. Once those drop, it gets more affordable. So it's interesting. All of a sudden, back in 21 and 22, people were over leveraging these assets. And now values haven't gone up. NOI hasn't gone up and cash flows haven't gone up as they predicted. Now you've got this time where these deals are harder to pay. I mean, the mortgages are where they are. They're resetting. Your debt is going higher. Your mortgage payments are higher. Now, if you had fixed rate long-term financing on that deal, you'd be okay. You would be able to weather the storm, but that's not the case. Now, I'm going to read the monthly delinquency rates that they had. In 2024 of December, they had 0.4%. 25, January, 0.42. March of 25, 0.46, and May of 25, 0.68. It may seem as if it's only 0.68, but you're going from 0.4 to 0.68 in 5 months. It's the highest rate since 2011. That's very interesting. It's a 70% increase. Now, some of the reasons why. Cheap money led to thinly capitalized floating rate loans. That's what ended up happening, right? Now, what they're saying is we're witnessing a slow motion unraveling of multifamily leverage, one floating reset at a time. And it's interesting because most of these loans, if they were taken out in 2021 and 2022, let's say in 21 you took out a loan, 3 years comes due in 24, a lot of these owners already went back and already did their workouts, already got an extension for a year, thinking that things were going to settle and that rates were going to drop. Now, here's my theory. My theory is that the Fed has not dropped rates because they're trying to actually weed out the bad operators, weed out the bad deals. They do not want a lot of these deals to survive. They want the equity from LPs. I don't want to say it to be wiped out, but really you're operating a deal that shouldn't be at that price point. They want to hit the reset button, but if they drop rates or they had dropped rates a year ago, a lot of these deals may have been saved. And a lot of these people that are trying to do workouts, they can't work out this deal. They can't kick the can down the road anymore. So at some point, you're doing a capital call. You're either going to do a capital call, or if you're going to say to yourself, here's another slogan from the South, you shoot your dogs early. Basically, were some operators that said, this ain't getting better. I've been through this. Let me sell this deal today at a loss. I may not get my investors' money back. I may lose equity on my side, but I don't see any future. Let me take a loss today. So get rid of the deal. Instead, a lot of the operators are holding on, and that's why you're seeing these delinquency rates go up. And we are back. You've heard the doom and gloom. You're saying to yourself, Gino, why am I in this multifamily thing? I can just go on, buy some Bitcoin. Yes, I have Bitcoin, I have XLM, I have XRP, I have Anchor, I have Shibu. I have assets. They're very, very small. I don't have a lot of money. It's just, for me, actually, I use it to teach my children, to show them the volatility of the market, right? What happens is people buy high and sell low. That's why everyone thinks they're making money by trading these assets. But the real people who make money in crypto and Bitcoin, they're the ones who hold long term. They're the ones who read the charts, are in there daily, looking at dips. They're buying on the dips. They're selling when the asset runs up. They understand. For us in multifamily, it's a lot more boring. The first thing that you can do is you underwrite more conservatively. And now I hear the moaning and groaning, but if I do that, I won't get any deals. That's the idea. And it may be counterintuitive, but you're continuing to write, and conservatively, sooner or later, you will find a deal. Now, I know if you're out there trying to make money, trying to do deals, live by this mantra, and it has served me well. And I know it'll serve you well. And then you may say to yourself, well, Gino, how did you learn this mantra? I lived it. No deal is better than a bad deal. Just keep repeating that to yourself. It'll make yourself feel better. And if you're out there listening and you've done a bad deal and you've owned it for 10 years and you've lost over $500,000 in equity, and you've had to deal with tenants who are crap, and you've had to deal with leases that were crap, and you've had to deal with property managers that were crap, you understand that. I know it's short-term pain, but it's long-term gain. Underwrite conservatively. Understand that rents aren't going up 10% a year. Understand that expenses are probably going up a little bit more than what you predict. Understand that exit cap rates have to be a little bit more conservative. Understand all that. Understand that, if you think you can get $1,200 in today's market for rent, maybe make it $1,100. It'll serve you well. And you may not get the deal, but give yourself some time. These deals are starting to unravel. There is more activity going on in the market. Stay in this market for the next 12 to 24 months and you will be so rewarded. Now, the next one, make sure that you have enough capital reserves. When Jake and I do a deal, we don't syndicate, but we have enough money set aside. On those loan to cost deals, 80% of the loan reserves for our capital reserves is funded by the bank. Great. But we also have capital reserves set aside that if something goes bad, we know what's going on. And if you go back to number one, to underwrite more conservatively, make sure that you have a capital budget that makes sense. If you're buying a deal, there's thin margins and the asset is old and you need to replace roofs and driveways and AC units, do you have enough capital reserves for that? And if you don't, you're going to be in trouble. If you need to raise more capital from your investors, do that. Be sure that you have enough. Get more in the front end than having to go back in the back end and doing a capital call. The third one, in this part of the market cycle right now, don't renovate your units for rent growth. It's just not necessary right now. You're going to be spending $10,000 a unit and you think you're going to get $200 to $300 per unit in rent bumps. It was great 2 and 3 years ago. And it may work in some markets, but the majority of the markets, it's not working right now. What I'd rather have you do is just make the unit rent ready, and you could possibly, if you're buying this asset with under market rents, get a rent bump. Do you remember tenant affordability? Be careful where you're buying these assets. Some residents don't care about granite and shiny appliances and smart thermostats and all that. Some do, but a lot of them don't. The tenant affordability is a real thing. So if you think you're going to go in, buy an asset that has $800 in rents, and I'm going to spend $10,000, and I think I'm going to go to $1,300 in rents, you may, but it's a lot more challenging in this part of the market cycle. And be careful with all the supply coming on. You're trying to start competing with higher tier assets. Those people in the higher tier assets, they're getting concessions. Those people that you're competing with, they may go to those higher assets. So be careful about renovating for pure rent growth in this part of the market cycle. Number 4, restructure the debt with the banks. If you've got an asset and your debt came due, call the bank up every day. I actually did this in 2008. I worked with a bank called Bayview. And I'm telling you, it was 2011 or 2012, debt was coming due. And I had a 5-year loan on it. But during that, from 08 to 12 and 13, the asset just did not do well. I could not rent out these commercial spaces. I violated every law of buy right, manage right, and finance right. But one thing I did do well is I was completely persistent because I knew the bank didn't want this asset back. What are they going to do with this thing? It was 50% occupied when I was running it. They're going to take it. They're going to lose their money. So what they said to themselves is, okay, we'll extend the loan. They gave me a nice extension, 10-year extension on this thing. They dropped the interest rate on it. It was friggin' awesome. My payments went down and I was able to breathe a little bit. Go out there, restructure the debt. Try to hammer the banks every day. Plead your case. Tell them you don't want this asset back. Just give me and work with me because I want to make this asset work and I want to make you money. Remember, banks are your biggest partner if you understand it or not. 80% loan to cost. 80% of that deal is funded by them. They are your largest partner. And the last one, just be wary of using bridge debt. Know that it's an amazing tool. It is great. But understand what rate caps are. Understand, going in, eyes open. Understand that you need to execute your business plan crisply, cleanly, and quickly so you're able to actually exit the deal. And when you're doing bridge debt and you're getting that type of debt, make sure that you have an attorney. Look at all of the fine print because it is very expensive. When you go to refinance out of it, it is expensive as well. Sometimes they have right of first refusals. You may have to go with the same institution that you got the original debt from. Just go in there eyes open. It's great when you're buying these value add deals, but it can also be wary. And once again, I'm going to mention the mantra, no deal is better than a bad deal. Now, as I wrap up, I just want you to think and not to be overwhelmed by saying, wow, up 70% delinquencies. It's still below 1%. And a lot of that is in the CMBS space as well. A lot of the loans in CMBS, collateralized mortgage-backed loan space, there's more risk in that. But it's okay. What you should be saying to yourself, especially if I'm newer or if I have capital to deploy, here's the opportunity. Because what I'm waiting to happen in this part of the market cycle is that buyers are saying to themselves, I'm not overpaying. I did that 2 years ago. I'm going to wait. Sellers need to, as we like to say, come to Jesus and say, my asset's not worth this price. It was 2 years ago. Now, if they need to sell, they're not getting that price. They're motivated. You as the buyer needs to understand what to look for in a seller that's motivated. Go back and listen to what to do in this part of the market cycle because it's really important and it's going to save you. Now, don't forget, if you want that free copy of Wheelbarrow Profits, just email me, gino@jakeandgino.com, and I'll send you a free copy. And as always, thanks for spending part of your day with me, and I will see you on next week's How To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.